a market where after New York had closed and on its way to Asia, there's virtually no liquidity. The traders in New York are done for the day. The traders in Asia are not at their desks. And someone comes and pours billions of dollars of gold and silver on the market. Now, that would guarantee you the least beneficial settlement you could ever possibly get. It would just trigger sell stops all the way down, and you'd get algorithms that would sell as these levels are being violated. There's no one there to catch the bid because there's no liquidity in the market. You know, you're talking some of the biggest banks in the world that are not just bullion banks that are playing this game of massive rehypothecation, 400 contracts to 1 ounce of gold or silver. In London, maybe 170 million ounce float, trading 600 million ounces of deliverable contracts per day, up to 2 billion ounces standing that are already out there that could potentially stand for delivery. I mean, what could possibly go wrong? And if one of these banks did fail, it's not isolated to the metals market. These banks are involved in all markets, from Forex to equities to, interest rates, you name it. The contagion, the systemic contagion is extraordinary. And you're right, it would have a big deal and a big impact. And furthermore, it's interesting, the guy who, I don't know his name, but there's a gentleman who's leading the development of the BRICS grain exchange, which is a reality right now. And about a year ago, he made a comment that caught my attention, more so because of the implications on the way the West has played the metals markets and all of the commodities. Roughly 1,000 commodities traded on COMEX, and you'll find that silver is always the number one largest concentrated short position. A handful, 8 Western banks hold it. Gold's right there, platinum and palladium right there. But the guy that's in charge of the grain exchange was being interviewed, and he said, we produce and we consume more grain here in the global South than they do in the West, and yet we have no control of the prices. That's controlled on COMEX, he said, but with the development of the grain exchange, that will change. And so what you have is an understanding that commodities have been controlled in a casino-style, speculative, Western-based prerogative manner for a long time. And the players around the globe, to me, understand that. And that's one of the reasons that they've been using the West's hubris against them, whether it be standing for delivery on commodities or positioning themselves in the grain market, the food markets, the soft commodities, or the Chinese buying the London Metals Exchange, or the Chinese endeavor in the Belt Road Initiative, which is 150 plus countries, largely resource rich and underdeveloped, or all of the BRICS partners are not only resource rich, but integral to trade routes on sea, on land. I think the bottom line is that to the rest of the world that is in some ways slowly challenging the hegemony of the West, it is all about commodities. And if you were to see one of these Western behemoth bullion banks default, failure to deliver on the LBMA or anywhere for that matter, the repercussions are severe. It's interesting because we did see more or less a default in the nickel market, and they rewrote the rules, so to speak, kind of like they did to the Hunt brothers. This is a high stakes battle that they're going to try and keep it going as long as they can. But as long as they keep it going, it plays into the hands of the BRICS nations, of the countries amongst the global East and South, the Asiatic countries, who are using the West's, I believe, fleeting time of controlling commodity prices to establish deals, trade deals in local currencies, and to accumulate future deposits and whatever isn't nailed down. So yeah, it's a big deal, not just silver collapsing, but the contagion and how fast it would systemically spread throughout the ecosystem. It's a good question and a very big deal, and one that you could sit and let your mind go, really wander for a long time and probably over a bottle of scotch and play that one out and see where it ends up. I mean, the easy answer would be central banks. Is there coordination here in the West? I don't know. We've become a massive importer of gold. There are so many crumbs out there pointing to gold being reintegrated into the monetary system. Could it be the Treasury Department through the Exchange Stabilization Fund? I don't know. Could it be the realization that the folks in the BRICS nations have been doing this for a very long time? And if we didn't get our act together, then what? It was interesting. It's been a several day pull down, but one of the things that we've seen, according to Michael Lynch, and he does a great job of analyzing the COMEX, is some big buyers as they drove the paper price down. Let me see if I can give you some actual numbers here. Broke my glasses this morning, so this ought to be fun. But some actual numbers that I think will explain exactly what I'm talking about. But in any case, the big buyers that have come in have been Bank of America and Morgan Stanley. And what's interesting is that you have Morgan Stanley that has publicly, their chief investment officer has come out and said the 60-40 mentality, or excuse me, the 60-40 plan that has always been in place for Wall Street, 60 stock, 40 bonds, should now be 60-20-20. Their chief investment officer is telling you to sell half your bonds and buy gold. Now, they've been a big seller on COMEX for a while. They've bought, 700,000 ounces in October, it looks like. And the other one was Bank of America. Their chief analyst, Michael Hartnett, who has a massively expensive newsletter, has said, no, it should be 25, 25, 25, 25, deviating from the 60-40 rule. Keeping in mind, these banks never recommended gold to their people, 5% at the most. And he's saying 25 stock, bond, short-term treasury, and 25% gold. So they're the big buyers as the price was driven down. What's interesting is that we've seen already almost 39 million ounces of silver delivered to COMEX here in the month of October. It'll be one of the biggest ones ever. And what's really interesting about it is that both gold and silver experience massive mid-delivery month deliveries, issuance. So what I mean by that is that most people who stand for delivery make the intention known on day one of the delivery period, like October 1st. But what we saw in silver, the deliveries are up 193% from the first day notice number. This showing a rush for physical metal as they drive the paper price down using the December contract and then come in and buy October immediate delivery contracts late in the cycle, which makes it tough to analyze because, most people are looking at the open interest and then try and discern who's going to stand for delivery on day one. Well, these guys come in, knock the paper price down, and come in the middle of the delivery period and buy a contract for immediate delivery. Same thing is true with gold, up 93% from first day notices. And it's a big deal because, you've had 6,000 between October 17th and 19th, I believe the 3 days, over 6,000 contracts were written for immediate physical delivery. Each of those were daily records for this point or that point in the delivery period. And so, you're looking at a situation where entities, to cover shorts, are driving paper prices down to buy immediate delivery contracts for the current month. All of this is happening, and one could argue is collusive, is in I'm sure, violation of several laws that the CFTC should be policing, yet, of course, they're on vacation right now as government is shut down. And it certainly has the footprints of big banks, not only covering shorts, but also big players that are being squeezed out of positions, covering, taking profit. A lot of the things that the public or that the mainstream media would have espoused are valid and true. It was extended, had gone up for 9 straight weeks. It was overbought. But when you see, as an example, last week, a market where after New York had closed and on its way to Asia, there's virtually no liquidity. The traders in New York are done for the day. The traders in Asia are not at their desks. And someone comes and pours billions of dollars of gold and silver on the market. Now, that would guarantee you the least beneficial settlement you could ever possibly get. It would just trigger sell stops all the way down, and you'd get algorithms that would sell as these levels are being violated. There's no one there to catch the bid because there's no liquidity in the market. It would guarantee the worst possible settlement. It was done for effect, and that's when Bank of America and Morgan Stanley came in and bought massive amounts of physical and pushed the price back up like you saw here today. Price goes down and then comes right back up. It reeks of short covering by large players who have too big of a position, these 4 or 8 Western banks, where the rise spike in gold that we saw in silver was creating borderline existential threat to some of these players, and this is the reaction that we should see. You know, I think that's the point, is that the mainstream media talks about the reasons, which many of which are valid, but they neglect to notice that part of the way this is done is by drive-by shootings in the most illiquid period of time, where any trader who would have done that, David, would be fired and shot, and most likely not in that order, if it were done for, for real benefit, and it just isn't. So I don't know. The trend hasn't changed. Really, the trend will not change until central banks stop buying gold, and they're not doing that. And this is just a breather. You also have the October sell season, where it's the end of the fiscal calendar. You got hedge funds need to balance their books and book their losses or their gains. You have November being the buy season, where now they come in with fresh capital and getting ready to redeploy it. So there's a lot at play here. But in the end, who benefits? The ones that were able to drive the price down and cover stale shorts, that in an environment where we see a lot of standing for delivery, which is an environment that makes having rehypothecated positions very dangerous.